Hi, everyone, and welcome to another episode of Investing Strategies. On this show, we're going one-on-one with the CEO of Cadence Design Systems, which earns a coveted spot in IBD's long-term leaders portfolio. Plus, blank check IPOs are the latest craze to hit the stock market. But what exactly are they and how can investors benefit? Well, IBD investigates. And large cap tech stocks have seen supersized gains in this current market rally. Frederick of the Schwab Center for Financial Research weighs in on that and more. Investing Strategies starts right now. Cadence Design Systems stock has surged in this market rally with shares roaring to new highs in May and never looking back. The electronic design software leader also is a member of IBD's long-term leaders portfolio. That underscores the company's long track record of not just share price outperformance, but fundamental strength over the long term too. And who better to provide insight into the company's success than Cadence Design Systems CEO Lip-Bu Tan, who joins me now. Thanks for being here today, Lip-Bu.
Thank you, Alisa. Thank you for inviting me.
Okay, great. Now, the company is very uniquely positioned to benefit from long-term technological themes that are still in the early stages, like 5G, self-driving cars, and artificial intelligence, just to name a few. So talk to us about how Cadence is helping enable these sorts of innovations.
Let me start with the overview of the company. Cadence Design is a kind of computational software specialized in the electronic design automation software. So we provide the software tool, IP, and hardware verification, and that is what we do. And then we have a strategy to move on to intelligent system design. And in the way we provide the design excellence, that's EDA and IP that we have currently. And we move on to the next level, next layer, is called system innovation. That is work on the system analysis and also the embedded software. Then the next layer will be the pervasive intelligence, that is AI, machine learning, to the vertical market. And a little bit background, the company is about 8,300 people and revenue is about 2.6 billion. And we grew about 11% a year this year. And then the operating margin at 33%. Market cap is about 31 billion. And that's kind of our background of the information of the company.
Great. And let's talk a little bit more about that growth that you mentioned that the company is experiencing. What areas of the business do you expect to continue to drive that growth moving forward over the next year?
Yeah, a couple of things. Like you mentioned earlier, the 5G, the autonomous driving, AI, machine learning, deep learning, and also the industrial automations. We call it the Industry 4.0, and also the whole hyperscale data center. Those are the 5 generation of waves that happening. And then right at the foundation is the electronic design, and that's where we come in. And so this is a very exciting time. And then the other part is basically that drive the growth is that we move into, I call it the data-centric revolution. It's all about data. And so how do you, create that, collect the data, by, generating the data, and then to organize the data, labeling the data, to do the data analytics, and then how do you store and transmit the data. And that is really transforming all the vertical industry. And that is really exciting for us. So I think we have a couple of things that are working for us. One is a hyperscale data center. They are all quietly building their own silicon to optimize their workload. And that was really a nice growth for us. And then same thing with autonomous driving. They have all the silicon, the sensor development. That is very exciting for us. And then the other big one is the industrial automation. They have all the data. How do you use the data to drive efficiency and productivity? And that really drives some of this, I mentioned earlier, intelligent system design, that we increase our TAM from 10 billion to 30 billion. So there's a huge opportunity to grow, and that's what we are excited about.
Yeah, it sounds like a huge total addressable market there. Can you put this into action for us a little bit? Give us an example of how you guys are really leveraging data to come up with solutions.
Yeah, so the design getting more and more complex. And so it really need our design solution software to really drive the improvement. And then even we use ourselves, the AI machine learning, to our own tool design. So that we use the parallelism, we use the AI machine learning because we have so much data. How do we drive better solutions for our customer? At the end of the day, is we really want to delight the customer so that they can design all the cool products that you and I, we can enjoy using. And that's something that we provide. And then the innovation, that, the tool improvement, and so that our customer, not just a semiconductor company, also a lot of system service providers, they can designing their product and then really optimize their solution to address the different workloads.
Now, when you're talking about a company that has seen such a long, successful track record of growth as Cadence has, innovation, as you're mentioning, is very key to making that happen. So how is Cadence able to keep up with the demand, from your customers to be able to deliver those cutting edge solutions when you have these new technological advancements cropping up and things are changing constantly, it seems?
Yeah, so a couple of things. I used to be a basketball player. I like to have a good team. And so I think the team culture is very important for us. And then the other part is, constant adaptive learning that I mentioned is important so that we keep learning new things and also listen to the customer closely. So I spend a lot of time with customer. So understanding what is their challenges and how can we provide the solution. And then I have a culture that in 48 hours, we get back to a customer. So we listen to them. They tell us where we need to improve and what are the challenges they need. And then most of the customer trust us as a trusted partner because we listen to them. We want to delight them. We do all the innovations to help them. And through some acquisition to, sometimes they even recommend which company to acquire, which product we need to have, so that we can serve them better. So I think at the end of the day, it's basically, we have the best product to drive innovation to them. And one thing to highlight, last 3 years, we have more than 20 organically developed products to support the customer. And then thirdly, we also use some of the acquisition to help, strengthen our products. And most important, listen to the customer and be their trusted partner.
Yeah, and 2020 has been a year that has thrown a lot of companies curveballs. So how have you been able to adapt this year? And what would you say is your biggest goal for the company in the coming year? And what are you going to do to work towards that goal?
Yeah, it's a challenging year, COVID-19 pandemics. But we basically, tried most of the employees, about 90% of the employee working from home. So we try to make sure that they can be productive. So we communicate a lot with our employee, our executive team, and then we also give them stipends to, get all the right equipment, the comfortable chair, and then, high-speed connectivity so that they can be productive. And also we use all the different tools for them to collaborate closely and also can communicate with customer, engage with customer. And so we're not going to lose a beat on that. And then I think that's very important for us, and then able to continue to innovate. I think that's very important. And then the other part is also we want to be the culture of inclusive, so that we include every different race and interdiversity in terms of gender, and so that we can work together collaboratively and over communicating. And that's very important. And then also we want to take care of the employee. So we give them extra time, and sometimes they work so hard with the Zoom or WebEx, and then we basically give some extra holidays for them so that they can really spend a balance with the family, the children, and then with work, and so that they can motivate and enjoy what they're doing. And that's very important. And so far, have been working very well for us. And then we're able to reaffirming our 11% growth for the year. And this is very unusual and very challenging market that we can be able to do that. And then one is the team working together. And then secondly, because our resiliency of our business, and our business is very predictable. And also we are contract with our customer is 2.5 years. And then we kind of work with them in the long term, the trusted relationship. And then, and also our revenue model is a ratable model. So that is very predictable. 85-90% of revenue is come from the backlogs. And that is very, shareholder love it. And that is very predictable. And then customer love it so that we can work on more strategically important to them.
Mm-hmm. And speaking of customers, who would you say are some of the key customers that you have, and what would you say is the biggest competitive advantage that Cadence has in helping you win those customers?
And we have a very broad customer base, in the thousands, and so big and small, and they're all important to me. And so it's ranging from the infrastructure player, automotive player, so mobile handset that you use, and then all the way to some of the industrial electronics. So almost anything that's electronic, they depend on my software tool and also IP for design. And so that is a very broad, and we're happy to have all the customer that work closely with us. In terms of competitive advantage, one, I mentioned earlier, we work as a team. And so every function, we work well together as a team. And then secondly, we delight the customer. We pay attention to customer, listen to their pinpoint, their challenges. We try to find solution for them. And then thirdly, continue the innovations. And I always believe the best product win. And it's very important. The customer would like to have the best product. So we always look out, 5 years, 10 years, what the customer need. And then how do we build that, or through acquisition to get there so that we can delight the customer.
All right. Well, on that note, Lip-Bu, we've got to leave it there, but thank you so much for your time today and for explaining the driving forces behind the company's impressive growth.
Thank you so much, Lisa.
All right. And coming up next, what do Virgin Galactic, DraftKings, and Nikola have in common? We'll tell you after the break.
IBD Digital gives you access to our premium content.
The best of Investors Business Daily.
A team with decades of experience serving up actionable investing content, a sophisticated tool set to facilitate your own deep dives, and educational resources that will give you an edge in the stock market. We have over 100 years of stock market data, all focused on one thing: what makes a winning stock.
We're taking the guesswork out of investing. Subscribe now to build a better portfolio and make more money in the stock market. Well, the latest craze to hit the stock market is special purpose acquisition companies, or blank check IPOs. Some of the big ones are Virgin Galactic, DraftKings, and Nikola. And joining me today to break down everything that you need to know about this new way of investing is Matt Krantz. He is IBD's management and personal finance editor. Thanks for joining me today, Matt.
Thanks for having me.
All right. So first off, for the uninitiated, what exactly is a SPAC or one of these blank check IPOs, and how are they different from traditional IPOs?
That's the question everybody's asking. So you're right on the money. The SPAC, the special purpose acquisition company, is another way for companies to go public. So we all know about the traditional IPO, where companies sell themselves to the underwriters and the underwriters bring them public in a big splashy debut. This is just another way of pulling this off, but it turns it on its head. So rather than taking the company public right away and you buying into shares of the company, what happens is you're giving your money to a sponsor. And this sponsor has 2 years to go shopping with your money to find a great deal. And you have the right, when they come up with the deal, to either decline it or to accept it. And it's at that point that the company goes public. So it's turned on its head. Rather than buying right into the company, you're putting your money into a cash reserve, which is then used by a company to go shopping and bring the company into the public shell. So the companies have 3 ways to go public. They can use the traditional IPO, which we just talked about, the SPAC, which we talked about, or they can do a direct listing. The direct listing is a method to go public when a company can't raise additional money. They're not allowed to raise additional funds. So they have 3 choices. The traditional IPO is fine, except the underwriters take a big fee of the deal, and there's a lot of uncertainty. Just ask the poor people at WeWork when they tried to go public last year, and all the dog and pony shows and all the underwriting and all the scrutiny found that that business model was a little shaky. That deal never happened, and it left the investors, the private investors, with big losses. The direct listing is great if you're Spotify or if you're Slack, and you don't need the money. You're so well funded, you're in good shape financially, your business model is sound. You don't need to raise money, that's great too. But there's a lot of companies that don't fit those two doors. They need to raise money, sometimes a lot of money. Some of them aren't even revenue positive. If you look at Nikola, the electric truck maker, they don't have revenue. At the same time, you don't want to subject yourself to the whims of the stock market. If you're going the traditional IPO route, if the market gets cold like it did in March of this year, you're out cold and you don't have any money. So it's a great option, but it's not going to replace the IPO. It's going to go along with it, but man, it's coming on strong. There's so many SPAC deals this year. They're setting new records. They're blasting past where they were last year, and they're now rivaling the number of traditional IPOs, which is why everyone's so excited about them.
Yeah, well, what do you think is exactly behind the excitement and intrigue of this versus doing that traditional listing?
So I'm going to be real careful when I talk about this because it's a little tricky. These SPACs have a two-pronged strategy. When you first buy the SPAC IPO, you put your money in the hands of the sponsor. The sponsor basically puts your money into a cash reserve and pays you interest. So if you think about that, you're basically putting your money away and you're guaranteed you can take it out at any time if you get out before a deal is made. So it's kind of like a bank. It's like a bond. It's like a pretty safe investment with an equity kicker, because here's the fun part. You give the money to someone, they shop around, they find an amazing deal. They've got the money, they do the deal. You're on the ground floor of this new company while you took no risk to get there. That's what people like about them. They like the fact that you can get a yield at the upfront and you have an equity kicker that exposes you to potential upside.
Well, in the traditional private equity market, a lot of places, there's a minimum threshold for investors in the amount of money they need to fork over. Is this different? Who all can buy into one of these before they actually go public?
Another great question. So in private equity, it's kind of a club. It's pretty clubby. You have to have you have to be accredited. You have to have a certain amount of assets. There's not much diversification. It's kind of an inside game. The SPAC is a great point that you bring up, opens it up a little bit. So you don't have to put your whole net worth into one private equity deal. You can spread it around in a couple SPACs. Some may work out, some may not, but you can spread it out and it's open to everybody.
And so with that, then what are the risks that investors out there need to be aware of with something like this throughout the various stages of the process?
So that is a good point. So they've changed SPACs quite a big deal here in the last 10 years or so. The big change now is you can still vote for a deal, but you can get your money out. You can basically get out of these things. The risk, though, is you have to pay attention because there's a cutoff. And if the person that you gave your money to finds a deal that you don't like, you only have a couple days to get out. So if you're on vacation and one of these deals goes out and buys the Ringling Brothers Circus, and you don't like that deal, and you were away, guess what? You're now in the circus business. So this is not, we cannot stress that enough. This is not for passive investors. If you like S&P 500 and QQQ and buy and forget and set and hold, this is not for you. You need to monitor these constantly.
So then you mentioned there's an equity kicker type aspect of this once we do see the companies go public. So let's take Nikola, for example. And with some of these, we've seen, even Virgin Galactic, we've seen a lot of volatility with those names. So how should investors be thinking about once that company does go public? How should they be thinking about that investment? It sounds like it is geared towards a little bit more of an active trader or someone who at the very least is willing to take on a little bit more risk tolerance.
Absolutely. And there's something that's kind of cool about these SPACs that makes take some of the guesswork out of it. They start trading usually at $10 a share, and they trade around $10 a share while the sponsor goes looking for a deal. The minute they find a deal, investors immediately react to it. So if you see the deal drop below $10 a share, that tells you that the other people that are in this pool with you don't like it. And that should be a red flag to you. They could be wrong, but there's a lot of smart money in these things, and they are betting against it. With that said, if they rise above the $10 share, the market likes it, or there's something about it that they like, and you might want to stick around. But with that said, you bring up a great point. As soon as it crosses the Rubicon and it becomes a stock and that equity kicker kicks in, you're on. I mean, this is a full-on stock now. There's no money back. There's no guarantee. You're on your own. So when that day comes, you need to not only know it's there, you need to make your decision, and then you need to know that at that point on, you have a risky company. And keep in mind, these are companies that did not go through the traditional IPO process. They were not vetted like these other companies were, and they need money. So it's kind of, when you pick this door number 2, the SPAC door, it kind of indicates the kind of a riskiness that you're not getting with some of the other deals.
Well, definitely a lot for investors to digest, but it's a very exciting area, and it sounds like one with a lot of potential. So thank you so much for helping us dissect the ins and outs of SPACs today, Matt.
Oh, thank you.
And after the break, Randy Frederick of the Schwab Center for Financial Research provides his perspective on the current market rally and the supersized gains from large cap tech stocks. We'll be right back.
I'm Arusha Pierce, and welcome to Investing with IBD. Every week, we are going to give listeners insight on how the market is doing. We'll identify stocks or ETFs that are worth considering and adding to your watch list. Not only do we have investing experts, we like to bring on business leaders. The response from listeners has been amazing. It really feels like we're building this community. Join me every week as we take on the market. Listen and subscribe wherever you get your podcasts.
Well, the stock market action we've seen in 2020 has been anything but ordinary. And joining us now to provide perspective on what active traders are thinking about in the market right now is Randy Frederick. He's Vice President of Trading and Derivatives at Schwab Center for Financial Research. Thanks for joining me today, Randy.
Hi, Liz. It's great to be with you today.
All right. Well, this has no doubt been a very historic year for the market in so many ways. So what's the general consensus among active traders in terms of the sentiment right now?
Well, I think, the year started out pretty well. And in January, things were looking good. And then, of course, the virus hit and it all kind of went south very quickly. And we came from finishing up the longest bull market in history to the shortest and quickest bear market in history. And now right back into another bull market. Depends on how you measure it. Some people would look at the bull market as having started when we went up 20%. That's typically how I look at it. But by any measure, since we recently, just last week, in fact, hit an all-time high, everybody, regardless of how they look at it, would not disagree with the fact that we are now in another bull market. So the sentiment's very positive. I think in many ways, a lot of the old traditional analysts are looking at valuations and saying, gosh, stocks are really expensive from a historical standpoint, but things are a little bit different now. Part of the reason is that, of course, interest rates are at 0 and they're likely to remain at 0 for several years. And that tends to push people into riskier assets like equities, which then in turn justifies a higher valuation level. So while stocks are stretched and they are expensive, I mean, the S&P 500's up, 53% since the bottom on March 23rd. So substantial. And in fact, the NASDAQ's doing even better. But most of it has been driven by a lot of those really big cap stocks. And if there's anything that the virus has done is it's exacerbated the difference between the haves in terms of the big, wealthy, mega cap stocks and the have-nots in terms of the small companies that have been struggling to survive in this environment, frankly.
Yeah, there's definitely been certain sectors that have been hit much, much harder than others. So when you're talking about the economic outlook for active traders, how are they kind of using that to almost inform their decisions about what groups, that they are playing as we may continue to see the market move higher?
Right. So the thing that we know is that throughout the majority of the last decade, and even a little longer than that, since the bull market began way back in 2009, technology and consumer discretionary stocks, which are typical cyclical leaders, but more so, I think technology even than the other have been the leaders in not every single year, but they've been the leader for the entirety of the bull market overall. And in many of those years, I think it was like 4 or 5 out of the last 10, the technology's been at the top. And we've seen the same thing again this year. This year, at least, it makes a little bit of sense, because the way I've been saying it is that the technology stocks, Silicon Valley, if you will, has been trying to convince us, everyone, consumers, that they were indispensable and that we couldn't live without them for a very long time. Some of us were skeptics. When the virus hit, and many companies, ours included, had to send many people home to work, then we found out that technology was indispensable and we had to have it. And in fact, had these guys not created the kind of abilities for us to stream things over the internet, to link up to our offices, to do all the things that we do from home. In fact, if this had hit 10 years ago, we wouldn't even be able to do what we're doing right now. So all of a sudden we find out that the companies we didn't realize we couldn't live without, we find out that we simply can't live without them. So technology continues to be a leader. It's been a leader for a very long time. And while the NASDAQ index is not strictly technology, it does tend to be very heavily weighted towards the technology stocks. And it's one of the reasons why it's a stronger outperformer. It's up 25% year to date relative to the S&P, which is only up about 6%. So what we find from more active traders is that they're willing to look into big cap tech stocks. And some of them aren't necessarily tech stocks, but we kind of think of them as such. So for example, companies like Facebook and Google and Amazon, they're not all tech stocks. Some of them are consumer discretionary, some of them are communications, but because they're technology driven and we kind of got introduced to them as tech companies, then we think of them that way. So now we find that people continue to put money into the same big companies that have continued to outperform. And while the valuations have gotten very high in a lot of cases, they're justified in the sense that they are indispensable, at least at the moment. And frankly, once we get out of this virus situation, hopefully sometime by the beginning of next year, they will continue to be leaders in all likelihood because they are so strong and they do have so much capital to work with.
Yeah, it's really seemed like almost a tale of two economies, when you just look at the stark contrast between the strength in tech and, industries, travel and entertainment and things like that getting hit really hard. But when you're looking forward at the growth that we've seen for technology, how much longer can we expect that to continue at the rate that we've seen it in this rally, with the extremely strong gains that a lot of these companies have produced?
Well, that's really an answer no one knows. That's really a question nobody really knows the answer to. But again, because interest rates are so low, many of these companies, even those that didn't need capital, have sold bonds at very, very low interest rates. So they've essentially filled up their chest full of working capital that they now can use, and liquidity that they can use for the next several years at extremely low rates. So they have lots and lots and lots of capital to reinvest in the business, to be innovative, to grow, to add employees, to add new technologies. The ones I would caution people about are any companies that have strictly benefited because of the virus. Those that were not necessarily on our radar screens, that we weren't paying attention to, those companies that have benefited just because we're home. Now, there may be some life left in them, but at some point when we do finally get back on our feet and we get back to something closer to the old normal, and I think, frankly, the new normal won't look like the old normal in the sense that many of the people who are working at home now, I think, will stay home. Not as many as are home now, but certainly more than were working from home prior to when the virus hit. So to some extent, there's at least some longevity there. But those that have benefited from things like our inability to go to the movies, or to go to a casino, or to go to a sporting event, or to go listen to music or something like that, gaming companies potentially, companies that have forced us to work out in our homes as opposed to going to a gym. Those kinds of companies that have had very sharp run-ups just since the virus hit, I think there may be some caution there in terms of their ability to continue to move higher. But the big giant mega cap companies who were a big part of our lives and growing more and more as a bigger part of our lives, even before the virus, have just gotten bigger since the pandemic and will likely continue to get bigger going forward. So how far they can go, no one knows. Technology sector in general has always run with higher PE ratios than most of the other sectors anyway. And what people often do is they'll look ahead to the next quarter and base the value of what they're willing to pay for a stock now on what the company might earn in the next quarter. That's been impossible for two reasons now. One is that many of these companies have suspended their guidance for the rest of this year. And secondly, we know that those earnings aren't going to come back in all likelihood anytime soon. So I would say that people are paying now what they think a company might be able to earn, say, in 2021. That's a little bit further out into the future, but that's sort of how the virus has kind of changed our perspective and our time horizons, and more recently, because it's just forced us to look out further than we might have otherwise.
Yeah. And what's your advice for active traders in terms of how they should be thinking about different moves for their portfolios when we see very news-driven events? You know, we have an election coming up, coronavirus, vaccine talk. I mean, there's a lot of different headlines that are still looming that could really move the market. So what's the thought process there for how to handle those potentially big shifts in market conditions because of that?
Well, I think the most important thing of all, and this is something now, I am Schwab's short-term analyst, so I do speak to people who trade a little bit more actively. But one thing I always emphasize, because this is very important, is that if you trade actively, you should not be trading actively with your entire portfolio. I believe, and we believe as a company, that everyone should be an investor, and that means have a very long-term time horizon. If within your entire portfolio, you want to carve out a portion of your portfolio to trade more actively with, I always say that should be no more than 20%. So within that 20% that you might be trading more actively, by all means, you can be news driven, you can be event driven, you can trade based on up or down moves in volatility, all the things that we've experienced this year. But don't make wholesale changes in your overall portfolio, your long-term investing based on things like the election. The best example, I think, is that there was a very, very strong sentiment prior to when President Trump got elected in 2016 that it would be a big negative for the stock market. Clearly, that has not been the case. In fact, if you compare President Trump to all of the presidents since World War II, the performance of the stock market under his term has been fourth best out of all the presidents since World War II. So that's pretty good. Now, it was in an uptrend when he came in, but even then, he has outperformed the trend that was created under Obama for his period, his first 4 years. So I think there's a big, I think, belief right now that potentially maybe a Joe Biden presidency might be negative for the markets because potentially he wants to raise taxes. I'm not saying that's right or wrong. I'm saying don't just assume that that's the case, because it may not be the case at all. In fact, what markets have historically liked best is when we have, it doesn't really depend on the presidency. It depends on what the makeup is between the presidency, the House, and the Senate. Generally, if there's a mix where you have Republicans in control of at least one of the three, or Democrats in control of at least one of the three, then the changes in government tend to be rather subtle and fairly slow and somewhat more predictable. The market generally likes that. When you have a Republican or a Democrat in charge of all three branches, then that tends to cause a lot of volatility in the market, because it opens the door for significant and very radical and very drastic change, which oftentimes is very disruptive to the market. So I would say, based on the election, those are the types of things that are more important than just who becomes president.
Interesting. Well, thank you so much, Rady, for providing your perspective today. We really appreciate it.
You're very welcome.
All right. And thank you all for watching this episode of Investing Strategies. For Investors Business Daily, I'm Alyssa Corum.